Bitcoin has just fallen below its average price of the past year. That average is calculated by taking Bitcoin's closing price for the last 50 weeks, adding them up and dividing by 50. People call it the 50-week moving average or 50 West MA, but put simply, it's the one-year report card of the Bitcoin market. When the current price drops below that one-year average, it means the overall health of the market is weakening. And throughout Bitcoin's entire history, every time its price fell below this level during an uptrend, the bull market ended shortly afterward. This time is no different. The moment Bitcoin broke below the 50-week average, it sent a very cold and very clear signal. The bull cycle may already be over. Most people still believe the market is just going through a quick correction. They think a few unexpected dips aren't enough to change the direction of the whole trend. But what they don't realize is that when Bitcoin falls below its one-year average, the market stops moving based on emotion. It starts moving based on pattern. And this pattern has repeated across 3 full cycles. Whenever Bitcoin loses the 50 West MA during an uptrend, a long, slow, grinding downturn follows, usually lasting 11 to 14 months. This isn't about news headlines or positive stories. It's about how the larger financial system reacts to this single piece of data. Most normal investors never see the mechanism behind it. They only see the price dropping. But behind the scenes, quantitative funds, algorithmic trading systems, and institutional asset allocation models are all using the 50-week average as a key marker for identifying where we are in the cycle. If the price stays below that level for too long, these systems are programmed to sell or reduce exposure. Not because they're scared, and not because they think Bitcoin is going to zero, but simply because their rules tell them to. When thousands of automated systems reach the same conclusion at the same time, the market begins to produce a chain reaction. To grasp the seriousness of this moment, you have to zoom out. Across 15 years of Bitcoin's history, every time the price dropped below the 50-week moving average, a long and tiring downtrend followed. And what makes this cycle different is the environment. This is not happening in a world full of stimulus or cheap money. It's happening while global liquidity is tightening, interest rates are high, central banks are withdrawing support, and risk capital is shrinking. Losing the one-year average in a setting like this is far more dangerous. It means there's much less fuel available to stop the decline. Here's how the whole system behaves. The 50-week average acts like a dividing line. When Bitcoin's price stays above it, funds have a technical reason to keep holding or accumulate more. When the price drops below it, the models start telling them to reduce risk. Futures positions begin to unwind as the market flips direction. ETF inflows start slowing or reversing because the average has been broken. Trading algorithms that follow momentum detect the shift and begin selling automatically. And when all of these mechanisms operate at the same time, the market falls into a loop. Selling causes lower prices. Lower prices cause liquidations. Liquidations cause more selling. If this cycle maintains even 70 to 80% of its historical rhythm, we are heading toward a familiar scenario. In the first few months after breaking the 50 West MA, the market still looks controlled. Prices drop, then bounce, then drop again. It feels like normal volatility, not the start of a bigger downtrend. But then the domino effect begins. Altcoins fall much harder than Bitcoin. Tech stocks, especially AI stocks, feel pressure as risk capital exits, and funds across the board start de-risking. In the next phase, margin calls begin to appear in highly leveraged accounts. Risky assets lose liquidity. Investors who were waiting for a big rebound start losing patience. Market sentiment gradually shifts to defense. Money flows into cash, bonds, and other safe assets. Bitcoin enters a slow, sideways down phase, where the price doesn't crash dramatically but also can't bounce strongly. This is the most exhausting stage, because nothing exciting happens. The market simply wears people down. Small investors leave. Meanwhile, institutions quietly begin accumulating again, preparing for the next cycle. For individuals, the impact is very real. Portfolios drop 30 to 60%. Leveraged positions get wiped out, and anyone who bought near the top is stuck. Risk capital exits not only crypto but also tech and AI stocks, leaving Web3 and AI startups short on funding. Consumer spending slows down because investors tighten their budgets. Venture capital reduces deployment. All of this starts from one trigger: the price falling below its one-year average. In the best-case scenario, Bitcoin quickly climbs back above the 50-week average, turning this entire move into a false breakdown. But in the worst-case scenario, Bitcoin stays below that level for too long, activating the full pattern of an 11 to 14-month decline, just like past cycles. History doesn't repeat perfectly, but it does rhyme. And right now, the rhythm suggests the downtrend might only be beginning. In the first part, we talked about how breaking below the 50-week average signals a structural shift in the cycle. But that's only the first layer of what's happening. Because the second layer is much bigger, and it explains why even strong news, positive adoption, and regulatory clarity couldn't stop the sell-off. To understand that, you have to look at the macro forces that move markets behind the scenes. These forces aren't emotional and they don't care about sentiment. They're invisible until the consequences show up on price charts. One of the biggest forces right now is global liquidity. It doesn't matter how optimistic people feel about Bitcoin or tech stocks when global liquidity shrinks. Almost every risk asset eventually gets pulled down. The most obvious example comes from Japan. For years, Japan was the quiet engine that fueled global risk-taking. With interest rates at or near zero, investors could borrow Japanese yen at extremely low cost, convert it into dollars, and invest in higher-yielding assets. This strategy is called the carry trade, and it allowed investors to earn the difference between low Japanese borrowing costs and higher returns somewhere else, usually in US bonds or equities. But once Japan raised interest rates, the entire incentive structure flipped. Borrowing in yen was no longer nearly free. And when you factor in currency hedging costs, that interest rate advantage disappeared completely. In some cases, it even turned negative, meaning investors would lose money by continuing the carry trade. So what did they do? They began unwinding it. That means selling dollar-denominated assets, everything from US bonds to tech stocks to Bitcoin, and moving the money back home. This isn't a rumor or a theory. It's a mechanical decision driven entirely by math. And when massive pools of capital make the same decision at the same time, the effects ripple across the entire global financial system. That's just one side of the global liquidity squeeze. The second side is the Federal Reserve. When the Fed ended quantitative tightening, many people thought that was bullish, because it meant the Fed was no longer draining liquidity. But in reality, the Fed usually ends QT only when it sees stress building under the surface. They never say it outright because that would cause panic. They always phrase it as being proactive or maintaining financial stability. But the market knows what it really means. Something is starting to crack. Once investors sense that the Fed might be reacting to hidden problems, they stop taking risks. They don't want to hold assets that swing violently. They don't want to be in crowded trades. They want liquidity and safety. And so they pull money out of Bitcoin, out of AI stocks, out of high-growth assets, and into cash or short-term bonds. Bitcoin, being one of the most liquid assets, becomes the first to react. It trades 24/7. It can be sold instantly. There's no delay, no closing bell, no settlement lag. When fear increases, Bitcoin gets hit first. It becomes the canary in the coal mine, but macro and technicals aren't the only forces at play. There's a third force, human psychology. The Bitcoin community has gone through internal disputes that most outsiders never hear about. For nearly a decade, there was a consensus that Bitcoin was meant to represent one thing: money. Not data storage, not digital collectibles, not pictures, not videos. Just money, simple, clean, immutable. But a change in the network removed an old limit on how much data people could attach to a Bitcoin transaction. Once that limit was lifted, people began attaching images, videos, memes, and all kinds of unrelated data to the blockchain. This opened the door for spam, bloat, and even illegal content being permanently embedded in the network. For some longtime believers, this wasn't a small update, it was an existential threat. They feared that Bitcoin could be attacked from the inside by filling the blockchain with unnecessary data, making it harder to run nodes and gradually centralizing the network. For many of these early holders, this was enough to trigger doubt. Not panic, just doubt. And doubt is all it takes for long-term holders to reduce exposure in the middle of a fragile macro environment. When people who have held for 5, 7, even 10 years begin trimming their positions, the market feels it. Then there is the fourth force, which ties everything together: the IPO moment of Bitcoin. Not a literal IPO, but a moment where early investors finally have enough liquidity to cash out without destroying the market. A decade ago, someone holding $1 billion of Bitcoin couldn't sell it. The market was too small. There wasn't enough demand to absorb the sale. But now, with ETFs, institutional buyers, national adoption, and massive trading volume, Large holders can exit positions worth hundreds of millions or even billions without causing a flash crash. And once the door is open, some of them walk through it. This isn't bearish behavior. It's rational. If you were sitting on $9 billion in Bitcoin, would you refuse to take profits because of some future prediction that Bitcoin might hit $1 million? Most people wouldn't. These early holders walked through every crash, every hack, every regulatory scare, every fear cycle. They held through times when the network nearly died. And now, after surviving all of that, they can finally monetize their patience. So they do, slowly, quietly, steadily. The market we're in now is the transfer phase. That S where early adopters gradually hand off their holdings to institutions and retail investors who entered later. This transition doesn't happen overnight. It takes months, sometimes a full year for supply to change hands. And while this process unfolds, price tends to drift lower or sideways until the selling pressure runs out. That's the shape of the current cycle. Understanding these four forces, technical, macro, psychological, and structural, helps make sense of what's happening. It also helps explain why price moves the way it does. Markets don't fall because of one single reason. They fall because several independent forces happen to align at the same time and push in the same direction. Once that alignment breaks, the market can recover. But until then, it behaves like a machine following instructions. For individual investors, everything we're seeing right now has clear consequences. The biggest mistake people make during these periods is assuming that price movement reflects sentiment. It doesn't. Price reflects liquidity, and liquidity reflects incentives. In a tightening environment, investors aren't selling because they hate the asset. They're selling because they need capital, or because their models tell them to, or because the opportunity cost has changed. That's why downturns feel emotionless. They're not dramatic, they're systematic. The second mistake is assuming that the bottom will be obvious. It won't. Historically, bottoms form quietly, when no one is paying attention, when volume is low, and when investors are exhausted. The bottom rarely looks like a moment of panic. It looks like boredom, flat prices, slow drift, a sense that nobody cares anymore, and that's why most people miss it. They expect fireworks, but bottoms almost never come with fireworks. The third mistake is misunderstanding time. People often think in days or weeks. Markets think in cycles, and cycles don't move quickly. A full downturn can last a year. A recovery can take another year. Big moves happen inside long, slow phases that test patience. The biggest returns typically go to the people who can endure the quiet parts. The best-case scenario is that Bitcoin reclaims the 50-week average soon, bringing back confidence and momentum. The worst-case scenario is that it stays below the average long enough to trigger the full length of the historical cycle. And history suggests that the longer the price stays under that level, the more likely the downtrend becomes. If this really is the early stage of a 12-month decline, then what we're experiencing now is only the beginning. But if the market recovers quickly, this could turn into one of those rare moments where a major breakdown becomes a trap for bears. There's no certainty, only probability. And right now, probability leans toward caution. At the end of the day, markets aren't personal. They don't move to hurt you or reward you. They move according to incentives, liquidity, and math. And once a cycle shifts, it takes time for the new direction to fully play out. Whether this becomes a prolonged decline or a short-lived breakdown will depend entirely on how global liquidity evolves, how institutions behave, and how long-term holders respond in the months ahead. But for now, the most important thing to understand is simple. Price is telling the truth before the headlines do. And the truth is that the cycle may already be turning.